Let me ask you something. You ever leave money on the table? I don't mean a tip at a restaurant. I mean real money, money that was yours for the taking, and you just walked away from it because you didn't know it was there. Or you knew, but you figured you'd get to it later. I'm 106 years old. I've been paying taxes in this country since 1928, 97 years. I've seen tax laws come and go like seasons. And I'm telling you right now, what just happened with this new tax law? This is a season you don't want to miss because for the next 3 years, we're already in 2025 and this window closes at the end of 2028. And retirees have an opportunity, a real opportunity. And most of you are going to let it slip away because you think taxes are boring or complicated or somebody else's problem. They're not somebody else's problem. They're your money. And I didn't spend 60 years running a business to watch you throw yours away. Let me tell you about my father. Enzo Benedetto came to this country in 1928 with $40, no English, and a leather satchel full of cobbler's tools. $40. You know what that is today? Maybe $6,700. That's what he had to start a life in America. And you know what he did? He worked 16-hour days. Factory during the week, fixed shoes at night and weekends. Every penny that came in, he knew where it went. Every penny that went out, he felt it. He used to say to me in Italian, because his English never got good, he used to say, Salvatore, the government always takes its share. And he was right. They do. But here's what my father also taught me. You don't have to give them more than their share. You pay what you owe, not a penny less, but not a penny more. That's not cheating. That's intelligence. So when I tell you there's a new tax law that can save you thousands of dollars over the next 3 years, I need you to pay attention, because this isn't some scheme. This isn't anything illegal. This is the government literally saying, here's a deduction, take it. And most of you won't. All right, let me break this down the way I'd explain it to my daughter, Lucia. She's 78, still sharp, but she doesn't like when I get too complicated. Here's what just happened. The tax law that passed, it makes the lower tax brackets permanent. That's important because until now, everyone thought the 2017 tax cuts were going to expire at the end of 2025 point. That would have meant higher taxes for almost everybody. The 12% bracket jumping back to 15%. The 22% going to 25% and so on. That's not happening now. The lower rates are staying. But here's the part that matters most. If you're retired or about to be, the standard deduction got bigger. And if you're over 65, it got much bigger. So for 2025, if you're married, filing jointly, your standard deduction is $31,500. If you're single, It's $15,750. But wait, if you're over 65, you get another bump on top of that, $1,600 per spouse if you're married, $2,000 if you're single. So, a married couple, both over 65, their standard deduction is $34,700. That means almost $35,000 of your income is completely shielded from federal taxes. Gone. The IRS doesn't touch it. And we haven't even gotten to the good part yet, you know. I think about money differently now than I did when I was young. When I was 31, my wife Anna Maria died, brain aneurysm. She was 28, I found her, on the roof where she'd been hanging laundry. The sheets were still wet. I was left with 2 small children and a rage in my chest that I didn't know what to do with. And I threw myself into work. 7 0-hour weeks, built my shop, made money, lost money, made it again. And for a long time, I thought money was just survival. You make it so you don't starve. You save it so your kids don't struggle. But here's what I learned later, much later. Money is also time. Every dollar you save on taxes, every dollar you don't waste, that's time you're buying back, time with your grandchildren, time to travel, time to do the things you kept putting off. So when I tell you to pay attention to this tax stuff, I'm not telling you to be greedy. I'm telling you to be smart, because the years you have left, they're worth more than any dollar amount. And the money you save can help you live them better. Now here's the part that's only available until the end of 2028. The clock is already ticking. 2025 is here, which means you've got roughly 3 years left to take advantage. Starting this year, there's a brand new thing called the senior bonus deduction. It's $6,000 per person over 65. So if you're married and both of you qualify, that's $12,000 extra. And here's what makes this special. It stacks on top of everything else. So that $34,700 deduction I mentioned, add $12,000 to it. That means a retired married couple, both over 65, has an effective standard deduction of almost $47,000 in 2025. $47,000 of income. That's federally tax-free. You understand what that means? If your adjusted gross income is $100,000, only about $53,000 of it is actually taxable. The rest, the government doesn't touch it. But, and this is the important part, this senior bonus deduction expires at the end of 2028, 3 years from now. After that, it's gone. Nobody knows if they'll bring it back. Nobody knows what the next administration will do. So whatever you're going to do with this opportunity, you have 3 years to do it. And 2025 is already slipping by. Let me tell you about a mistake I made. In 1978, my shop burned down. Electrical fire. 30 years of work gone in one night. I stood in the ashes thinking my life was over. But the neighborhood came together. Mrs. In turn to Shen from the laundromat, Mr. Ali from the bar next door. They raised mon. I showed up with hammers and paint. I reopened in 1979. Now, here's where I was stupid. The insurance company offered me a settlement, and my accountant at the time, guy named Morty Feldstein, good man, rest his soul. Morty told me there were ways to handle that money that would save me a lot in taxes. Spread it out over a few years, put some into retirement accounts, structure things properly. And I said, Morty, I don't have time for this. I need to rebuild. So I took the money all at once, paid taxes on it all at once, lost thousands of dollars. I didn't have to lose thousands because I was impatient, because I thought I'd figure it out later, because taxes felt like somebody else's problem. Don't be like me in 1978. Don't leave money on the table because you're too busy or too confused or too convinced that it doesn't matter. It matters. So what should you actually do with these 3 years? Let me give you some specifics. First, if you've been thinking about Roth conversions, now might be the time. A Roth conversion is when you take money from a traditional IRA where you haven't paid taxes yet and move it to a Roth IRA where it grows tax-free. The catch is you have to pay taxes on whatever you convert. But with this bigger standard deduction and the senior bonus, you might be able to convert a chunk of money while staying in a lower tax bracket, maybe even while paying zero federal tax. Talk to your accountant. Run the numbers. But this 3-year window, it's made for Roth conversions. Second, if you've got investments sitting in a regular brokerage account with gains you've never realized, this might be the time to harvest some of those gains. Harvesting gains just means selling something that's gone up in value. Normally, you'd owe capital gains tax on that. But with a higher standard deduction, you might be able to realize some gains while paying little or in. Other ways to connectize, you reset your cost basis, which means less taxes later. Again, talk to someone who knows your situation. But don't just sit there and do nothing. Third, think about smoothing out your income over these 3 years. A lot of people wait until they're 73 or older to start taking money out of their IRAs because that's when required minimum distributions kick in. But if you wait and then suddenly you're forced to take out big chunks, you might end up in a higher tax bracket. These next 3 years with the extra deductions might be a good time to take some money out early voluntarily at lower tax rates. So when those required distributions hit, you've got less in the account and the tax bite isn't as bad. I know this is a lot, and I know some of you are thinking, yes, I don't have an accountant, I don't have a financial advisor, I just have me and my Social Security check. I understand. When I started my shop in 1952, I didn't have accountants, and I had a cigar box where I kept receipts and a notebook where I wrote down who owed me what. I learned as I went, but here's what I want you to understand. You don't have to be rich to benefit from this. Even if your income is modest, understanding your standard deduction matters. Knowing what you owe versus what you're overpaying matters. And if you don't have a professional, at least go to the IRS website, look up the standard deduction for your filing status, look up what the tax brackets are, know your numbers, because nobody is going to care about your money as much as you do. That's just the truth. Now, there's one more thing I need to tell you about the senior bonus deduction because it's important. It phases out if your income is too high, if you're single and your income is over $75,000, the bonus starts to shrink. If you're married filing jointly and your income is over $150,000, same thing. Once you hit those E thresholds, you start losing the bonus dollar for dollar. So if you're right around those numbers, this is where planning gets really important. You might want to manage your income through timing withdrawals, or managing when you take Social Security, or other strategies to stay under those limits and get the full deduction. This is not something to figure out on April 14th. This is something to plan for now, at the beginning of the year, so you can make smart decisions all year long. You know, my second wife, Gloria, God, I miss her. She used to handle our taxes. She was a retired nurse, but she was sharper with numbers than most accountants I've met. She'd sit at the kitchen table with her reading glasses and a calculator and go through everything line by line. And she used to say, Sal, the tax code is written by people who want to help themselves, but buried in there, there's help for us too. You just have to find it. She found it every year. Deductions. I didn't know about credits. I would have missed. She saved us thousands over the years. Gloria died last January, 95 years old. I woke up holding her hand and it was still warm. I'm sorry. I didn't mean to get emotional, but the point is, she would want me to tell you this. She would want you to know that the help is there. You just have to look for it. You just have to care enough to pay attention. Don't let this window close while you're not paying attention. Let me give you your homework. And yes, I'm giving you homework. I'm 106. I've earned the right. This week, I want you to do 3 things. 1, Find out what your standard deduction is for 2025 based on your age and your filing status. Write it down. Know the number. 2, if you have any retirement accounts, IRA, 401k, whatever, find out how much is in there and think about whether you want that money taxed now at these lower rates with these bonus deduct. Ions or later when who knows what the rates will be and the bonus is gone. 3, if you have a financial advisor or an accountant, call them this week. Tell them about this 3-year window. Ask them what you should be doing differently between now and the end of 2028. If they don't know what you're talking about, maybe find someone who does. And if you don't have anyone, if it's just you, then start learning. The internet has everything. There's no excuse for not understanding your own finances anymore. I'm going to tell you something. My father never told me because he wasn't good at saying things like this. I'm proud of you for watching this far. I know taxes are boring. I know it's easier to just ignore this stuff and hope it works out. But you're still here. That means you care. That means you want to do better. And that's all any of us can do. Care. Pay attention. Try to do a little better than we did yesterday. This 3-year window, it's a gift. Not a big dramatic gift, but a real one. The kind of gift that can mean a few extra $1,000 in your pocket. The kind of gift that can mean one more trip to see your grandchildren, one more year of not worrying quite so much. Take the gift. Don't leave it on the table like I did in 1978. Don't tell yourself you'll get to it later. Later has a way of not showing up. You've got 3 years. The rest of 2025, then 2026, 2027, and 2028. That's it. Then the window closes. Make them count. All right, that's enough from me. Go call your accountant or your kids or both. I'll see you next.